Small cap franchise and retail group Taste Holdings released its first half earnings today, with headline earnings per share up 45%, now at 4.5 cents. Certainly a tasty showing, but valuations are looking stretched. Joining us for more on the numbers, Carlo Gonzaga, CEO of Taste Holdings. Welcome, Carlo.
Thank you.
Got a bit of mozzarella there on your shoulder. So I want to ask you about these numbers. The consumer certainly has no qualms about going out and buying pizzas, despite what we hear about the state of the consumer.
Yeah, it would seem not. I mean, our numbers have been driven by some good organic growth. And quite interestingly and unintuitively for some people, certainly our jewelry segment as well.
So I asked you off air about the 45%. Are there any technicalities driving the number? So just repeat for viewers what you said.
No, it's just a good performance for the 6 months.
So jolly good. So the question one, obviously thinks it's a small cap company and you often get compared with the likes of famous brands. So I rather rudely said last week that you're the poor man's famous brand. So I'd love to hear how you'd react to that.
Yeah, look, I mean, I think in part of our business we compare to them because there really is no other place for people to put us. But we're probably quite different in the sense that we do have a jewelry business. And our longer term view is to be diversified beyond that. Right now, in the last 2 years, we've been very focused on growing our food business. And quite frankly, I also see nothing wrong to be compared to anybody else. Our brands, consumers don't see it that way,
yes.
Because they certainly decide which brands they buy.
So diversifying beyond that, will that be through acquisitions? That's what Famous Brand did has been doing on an ongoing basis. Will you be buying more?
So, you know, a lot of people, when they say acquisitions, they sort of say it was a bit of a dirty word. I can tell you, I think it's almost harder to grow by acquisition than it is to grow organically sometimes. Not every company successfully can acquire and integrate businesses, and I think that we've certainly learned a lot of lessons along the way. So we do like a blend of growing by acquisition as well as organic growth within our brands, which is why we talk about same store sales all the time, and our existing brands keep on growing in terms of store numbers. But growing by acquisition is by no means the easy route to growth.
Is it partly, as you say, it's difficult to integrate new businesses? Is it also about buying at the right price and different philosophies and combining them?
Yeah, I mean, acquisitions are really straining on an organisation. I think you've got to be set up in order to be able to acquire and integrate businesses. They require a lot of work culturally. Internally, you've got to have a very strong and clear identity about who you are and what you want the other business to do and not to do. So, I mean, I certainly think that not every company, and there are a lot of failures as well, can successfully acquire and integrate businesses. So
you say you've now integrated the fish and chip company, but it seems this might be an example of one of those where the culture is different. They somehow don't want to be in your stable. They're kicking up a fuss. So there's a legal dispute. You say it's baseless.
Yeah, well, let's clarify that. The owners who weren't part of the business from the day we took over are the ones that are claiming a dispute of some sort. As for the rest of the employees and the franchisees, they've been fully integrated. And oddly enough, they've got a very similar culture at employee level to the one that we have.
Then going back to your strategy, if you look at your relative costs as you report, those have been coming down, I think, for 4 reporting periods. Yeah. So presumably that's about efficiencies. How much more do you have there?
Well, it's efficiencies and economies of scale. So, you know, if you start to think on our supply chain particularly, some of the volumes that we are doing now are truly staggering. So a question we were asked earlier today was, you know, what do we do about food inflation? And so far our response is that we're reasonably fortunate that the volumes that we are doing are enough that we can leverage that to minimise that pass-on effect to franchisees and then ultimately to consumers. So we still think we've got quite a bit of headroom to go in terms of our cost ratios, and it's quite a big focus of ours.
And with it, these distribution centres that you've now put in place in Gauteng and Cape Town, that's part of the plan, right? And more to come?
Absolutely, yeah. So, and we've got a KZN one planned in the beginning of next year.
What are the risks of for instance, building these distribution centres? You've already spent about 2 million, another 1.5 million to come. It's from your cash resources. You don't have to look in your bank manager's eyes, but there might be risks.
Sure, you know, it's another part of our business. It's complicated. When we bought the fish and chip company, though, what we did buy is we also bought a distribution capacity because they were already distributing to some of their stores. So we've taken some of those skills and acquired some other skills. And with that, so it's not really that we've gone from 0 to 450 customers, but it's been quite a big growth. So we certainly are quite wary that there'll be some initial operational risks. But in the long run, we think that it's the right thing for the business and our franchisees.
And Carlo, on the NWJ business, it's very clear that the corporate-owned businesses are faring far better than the franchise-owned businesses, which to me seems counterintuitive. Why is that?
Well, the real reason, to get the crux of it, is that franchisees in a rising commodity environment have got to be able to take their profits and reinvest it in stock that cost them 50 grand last time, now cost them maybe 65. So clearly when you don't have a strong balance sheet, that becomes problematic. But that said, we've seen some great results from our franchisees, and we've really been picking away at trying to get them to mimic our corporate stores. And I think in September they were 25% like-on-like, August 7.5%, in jewellery, which most people think you wouldn't sell any of.
Yes. Exactly. Carlo, thank you. So lovely having you here, and we're keeping an eye on you.
Thank you.
Price earnings ratio at 22 times, so you need to keep delivering. That's Carlo Gonzaga, CEO of Taste Holdings.